Let's do them in order. Quantitative easing. If you and I did it, it would be called counterfeiting. It's producing more specious currency units. I don't know about you, but when I was brought up, producing more of something at zero cost with zero utility was inflationary. It doesn't make the existing stock more valuable. Worse, debt and deficits. I can't speak to Canada, your country. But in my country, we have $32 trillion in on-balance sheet liabilities and $100 trillion net present value of off-balance sheet liabilities. It's $130 trillion at the federal level. We service that debt with a budget that's in deficit to $2 trillion a year. I mean, that makes you even nervous about the debtor, the U.S. government. But it gets worse. Negative real interest rates. Nothing could be more concerning about the strength of U.S. dollar-denominated savings products than the government's explicit guarantee that if you loan them money for 10 years, you will end up poorer than when you started. That's the first government guarantee in my life that I have faith that they're going to follow through. The fourth is simple market share. Precious metals and precious metals-related assets. Kitco will love this statistic, by the way. The market share of precious metals and precious metals-related assets is 0.5% in the U.S., which is to say 0.5% of savings and investment products in the United States are in precious metals-oriented assets. The 4-decade mean is 2%. If acceptance of precious metals and precious metals-related assets merely reverts to mean, demand increases fourfold. And that's precisely what I think is going to happen.